turtle souped it right back down into the initial run. That shift right there, below the swing low in here, that displacement is significant. Go back over your NASDAQ chart and you'll see that this short-term run here stands out on your chart. So when I'm looking at price action where price has been made jagged, like it does here, I don't need it to take out that low. I just need it to show me these types of fair value gaps. So when they stand out in price action where price has had a turtle soup, a major displacement, or it just leaps out at the chart, zooming out, not zooming in tighter, okay? By zooming out, your eye will jump right to these types of swing highs and swing lows. And when these runs are occurring, there's lots of manipulation in that. And you're going to be best served by going in and looking for these types of imbalances when they first form. Notice there's no fair value gap here until that, after it took that high. So this PD array is first presented fair value gap after turtle soup. Now this can be done on the buy side. This is a sell side. So what we're looking for are standouts for fair value gaps. And it's a lot of times, you've probably seen it when I allow people to leave comments. And it's a love fest in these things on YouTube most of the time. But usually I'll have 3 or 4 guys come in here and try to be a clown. And whatever, you're welcome to your opinion. But I'm not providing a stage for that type of stuff. But the comments that come up a lot are, why did I pick that fair value gap in that respective video they were commenting on? And over the years, obviously, you're seeing now there's a rhyme and reason to what I'm doing. And it's a slow drip, slowly, disseminating the information, because there's a lot of people out there repackaging my stuff. I'm not repackaging anything else. But that's the excuse that they're trying to put out there, that I'm repackaging something else. And it's simply not the case. I want you to think about how what I just said about here. When you have a turtle soup sell-off, buy side taken, and it starts to sell off, you don't need this to be a market reversal. You just need it to show these types of characteristics. The first fair value gap that forms after that, keep that on your chart. Project that forward. Think about the up-to-data ranges. What's the lowest one? 20 days. Keep it on your chart for 20 days. That's why this is still valuable to me. Now, by projecting that forward in the future, I'm already ahead of the curve. And I know this level is going to be important well before your volume profile is populated on your chart. Well before your Elliott wave stuff shows up on your chart. I'm in the future right here. I already know this is going to be a viable level in the future. Now I just simply have to wait for time to agree and meet with that price. What does that look like? Well, that's the high of that run. You're cherry picking this guy. If that's how you think, move along. It's okay. It's not my aim to try to convince all of you. Okay. But that's what that level is. And I want you to start collecting them on your charts. And this is why having one market and being a specialist is important, because when you ask me, what do I have written down on my little notepad? The little notepad I keep next to me. It's things like this. And because there are some things on there that I don't want to teach yet, I know thousands of questions will pop up as soon as I show you it, and I'll frustrate you because I won't answer it. I'll ignore it. I'll put you, to the side and disregard your comment. And it's meant to manage the information before I release it in book format. Okay, so it's simply allowing you to understand for free here. So now you don't need to worry about that in the book. It didn't cost you anything. You're just watching it for free here. But you're looking for the first presented fair value gap after a turtle soup sell-off or sell-side liquidity raid and runs higher. So having these on your chart, again, you can collect these in a workspace on TradingView or whatever your platform is, or you can be old school like me. I just simply write it down. Now, that might not be helpful to some of you because you're high tech. You want to see it, push a button, it populates on your chart, and it does everything for you And I can see the advantages of doing something like that, but I just like to know why I'm using it, where it came from. I have my hands on it. So I prefer the high touch over high tech. And that's the old dinosaur in me. I'm an old head when it comes to things like that. I'm never going to change. I'm too far gone in the game, and I don't have as many years behind me as or ahead of me as I do behind me. So I have to be realistic about things, right? So that's the market reaction there. Now, right away, you should know the opposite of that. It was a nice little rally all the way up in here, and overnight, here's your lows. So cast forth a vision. If it's running quickly up to that level and it proves to you it doesn't want to stay there, it starts to sell off. And then we're entering the time of day when we're looking for the opening range, 9:30 in the morning Eastern time to 10 o'clock. We're looking for that first presented fair value gap. That's that right there. Now, right away, you can see it's using it here and here. And where do you think it's drawing to? Before this even formed, before 9:30 even happened, while it's dropping down, in your mind, you're going to cast forth a vision. This is what I do. I'm looking at the market and I'm casting forth a vision. I'm waiting for a price run that creates a long, protracted down close candle. I'm waiting for that to form. I'm anticipating that to form. Because I know all of this reaction from this run here is likely to see us go all the way back down to take overnight lows. That's the draw. Now, the easiest way for you to have this on your chart or a routine is overnight lows. Just simply mark off midnight Eastern time to 7 o'clock in the morning. Whatever the lowest low there is, if it's relative equal lows, that's a loaded deal. That's where liquidity is. It's going to want to seek that if it's bearish. Not all the time, not that very day, but that's how I classify it. I'm looking for that lowest low overnight. In this case, we can see it being here. So that's a relative equal low. So you can see that that's obviously a standout. That's your sell side liquidity. We have the displacement here. So that's the first presented fair value gap after 9:30. And the market uses it here and here. And then we start getting into this back and forth type price action. This is classic of the holiday season. Again, another reason why I'm not a fan of trading around this time. I'd rather spend the time with my family. And by the way, I hope you had a very nice Christmas. Mine was wonderful. I hope you had a safe New Year's. Hope you're not hungover right now listening to this. You should learn from that. Don't do it again. But in here, we're going to take a look at this. We're going to zoom in and deal a little bit more with this. But I want you to think about that level right there being these lows. That's the draw. So I'm casting forth a vision, or you would be casting forth a vision on how price would traverse from this first presented fair value gap down to that low. When the majority of the run was accelerated, so half that run was real quick and sudden. And now it's a lot of give and take back and forth, reaching down into that sell side liquidity pool overnight. So we're going to focus in on that little area right there, and we're zooming in. All right, look at this guy looking at you. Yeah, I know you got to keep your eye on him. Sell side imbalance, buy side inefficiency. The market creates the fair value gap when this candle closes. It trades up into it here, and we're anticipating price reaching lower. The market drops down, comes right back up, trades to the low of the fair value gap. That's the first presented fair value gap. We do not abandon the idea it's reaching for overnight lows. You cast that vision forward. On the chart, you're expecting it's going to deliver. Until you're proven wrong and it's obvious, you keep that vision in mind, how it's reaching towards that relative equal low overnight. Every single candlestick has its place. It has its role in the plot. But not every single candlestick is a supporting actor. And it's not a leading man or a leading woman in the plot. That's the difference between what I see other people do with supply and demand and they say that I use supply and demand and renamed it. No, 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 no. That's not what this is. I'm going to show you a lot of things here tonight, and it's going to look different in the future when you start thinking this way. When you're watching price action, it's going to help you. If you're brand new, it's not going to be as helpful because you just don't have the experience having worked with the things I've been teaching for years. But the more veteran students will get more out of this lecture than someone that's new. And it's not by design. It's just that's how it is, okay? You don't know how to do everything the first time you sit down and watch it. So the market creates this run up and then starts to slowly work lower, then gyrates sideways, moves a little bit lower, gyrates sideways, and it starts looking like a very frustrating type of profile, not volume profile, not the market profile that you guys are thinking of. It's simply how price is being held in consolidation. So